Listen to me carefully. You have worked your entire life. You saved, you sacrificed, and you finally made it to the finish line. But now, you are facing a reality that catches so many retirees completely off guard, and it breaks my heart because it is entirely preventable. You are asking yourself, which amount of my money is actually taxable after I retire? You think that just because you are retired, the tax man forgets your name? Oh, no, he doesn't. In fact, if you aren't careful, the IRS is going to become your biggest beneficiary. The biggest fear I see out there, the thing that keeps you up at 3 a.m., is the terrifying thought of running out of money before you run out of breath. And let me tell you, taxes are the silent leak in your retirement bucket. If you do not understand what is taxable and what is not, you are going to miscalculate your income, overspend your nest egg, and find yourself in a financial mess when you should be enjoying the best years of your life. So let's get real right now. Let's answer the question clearly, honestly, and directly. First, we need to talk about your pre-tax retirement accounts. I am talking about your traditional 401k, your traditional IRA, and your 403b. Every single penny you pull out of these accounts to pay for your groceries, your travel, or your medical bills is taxed as ordinary income. The IRS let you catch a break when you put the money in, but they are standing at the exit door waiting to take their cut. If you pull out $40,000 from a traditional IRA, you do not get $40,000. You get $40,000 minus federal income tax and potentially state income tax depending on where you live. Do you understand that? You must look at those account balances and immediately discount them by your tax bracket. That money is not all yours. Those forced distributions get added to your income, pushing you into higher tax brackets and triggering a chain reaction on your other retirement benefits. Which brings us to the biggest shocker of them all, your Social Security benefits. So many of you believe that Social Security is completely tax-free because you already paid taxes into the system your whole working life. I wish that were true, but it is not. The IRS uses a devious little calculation called combined income to determine if they can tax your benefits. They take your adjusted gross income, they add any tax-exempt interest you earned from things like municipal bonds, and then they add 50% of your Social Security benefits. If that combined number is more than $25,000 as a single filer, or more than $34,000 if you are married filing jointly, up to 50% of your Social Security becomes taxable. If your combined income crosses $34,000 as a single person, or $44,000 as a married couple, up to 85% of your Social Security check becomes fully taxable. Look at those thresholds. They are incredibly low, and they haven't been adjusted for inflation in decades. It is a trap that ensnares middle-class retirees every single year. What about your investments held in standard, taxable brokerage accounts? If you sell stocks or mutual funds to fund your retirement, you will owe capital gains tax on the profit. Now, the good news here is that long-term capital gains rates are lower than ordinary income tax rates. In fact, if your total taxable income is low enough, your capital gains tax rate could be 0%. But if you are constantly buying and selling, or if your mutual funds are throwing off capital gains distributions at the end of the year, that adds to your taxable income and squeezes your budget. Even your pensions are almost always fully taxable as ordinary income. If you are lucky enough to have a pension from your employer, expect that check to be taxed just like a regular paycheck. Are you feeling overwhelmed? Are you feeling like there is nowhere to hide? Do not despair, because there is light at the end of this tunnel, but only if you take action. There are parts of your retirement portfolio that the IRS cannot touch if you play your cards right. The crown jewel of your retirement strategy needs to be Roth accounts. Withdrawals from a Roth IRA or a Roth 401k are 100% tax-free, provided you've held the account for 5 years and you are over age 59 and a half. Why? Because you already paid the tax on that money before you put it away. When you pull $50,000 out of a Roth IRA, you keep all $50,000. It does not count toward your adjusted gross income. It does not trigger taxes on your Social Security. And guess what? Roth IRAs do not have required minimum distributions during your lifetime. You are in total control. Another tax-free haven is the Health Savings Account, or HSA. If you used an HSA during your working years and saved the money, withdrawals used for qualified medical expenses are completely tax-free. Since healthcare is going to be one of your largest expenses in retirement, using tax-free money to pay for it is a massive win. So, what is your actionable takeaway right now? How do you protect yourself from this tax trap? Your immediate step is to stop treating your retirement accounts like one giant pot of money. You must practice what I call tax bracket management. You need to look at your income sources and strategically blend your withdrawals. If you need $50,000 this year, do not take it all from your traditional IRA. Take a portion from your traditional account up to the top of your current low tax bracket, and then fulfill the rest of your cash needs from your Roth accounts or your taxable accounts. By doing this, you keep your official income low, you protect your Social Security from being taxed, and you keep yourself in control of your financial destiny. If you are still a few years away from retirement, look into Roth conversions. Talk to a professional and see if it makes sense to pay the tax now at today's known rates to move money from a traditional account into a Roth account, so it can grow and be withdrawn completely tax-free later. You must be proactive. Do not wait until April 15th to find out how much of your hard-earned wealth belongs to the government. Know your numbers, manage your brackets, and protect your security. Because you're worth it, and nobody is going to care about your money more than you do.